Buffett wins big again, and we go on a hunt for big value in small banks. This is where the money is. All right, guys, as always, we're going to start off with the headlines today. The first one is that the Federal Reserve just released their opinion survey results of senior loan officers. So, David, did you find anything surprising in the results?
So the way they break out the survey, for them, mostly it's business loans, so C&I loans, and then they have a section for residential housing standards. And the survey kind of just tries to gauge how much have credit standards eased in the last month or so, the last year or so, just to get a feel about what's the environment like out there. And on the business side, the commercial lending side, a fair amount of banks said that they had eased their standards. So not being as picky in terms of who they're giving loans to, as opposed to on the consumer residential side, the banks aren't budging that much. They're still not eager to go out and give subprime loans, anything out of that prime category there. So when we look at just the commercial side, increased competition, that may drive some banks to get a little bit more risky. Just the nature of the business, more people are vying to give that loan. You may push the envelope a little bit, so it makes sense that these standards are easing.
I think this reflects a little bit the financial crisis itself. Everybody was expecting that there was going to be this big implosion in commercial real estate, and it never really came. And so, as we look to the recovery, now we've got a lot more heated competition in the commercial space, and then this reluctance to sort of get back into the residential lending. And part of that too, I mean, the inventory has been so low on the residential side that we've seen prices go up as a result. So there just hasn't been the need for a huge expansion in residential lending. Hopefully we'll see that, because that's what we need to help get the economy going. So as that residential lending, as the residential activity starts to pick back up. In the meantime, investors in banks with sort of a commercial bent to them, when you look at the biggest banks in the country, they kind of have a mix of everything. As you get down to some mid-size and smaller banks, think like a U.S. Bancorp, a little bit more tilted towards commercial lending, like a PNC, a little bit more tilted towards commercial lending. Just want to watch and make sure that nothing's getting wonky with the way that they're lending, with the results that they're seeing out of their commercial business, because that's the risk that you run when lending standards start to ease up like this.
Yeah, I think it's really the smaller players. If you're an investor in a smaller regional bank, you'd be a little bit more concerned, as opposed to if you're an investor in Wells Fargo, which is a little bit more diversified in terms of their interest income and their non-interest income. So if you think about a bank like KeyCorp, again, very big in commercial lending, so those smaller players that have to reach more and really go further down the risk spectrum, that could be a little bit concerning if the competition really starts to heat up and people are just maybe easing a little too much.
All right, next headline. Warren, of course, the big news today is that Amazon CEO Jeff Bezos bought the Washington Post for $25 million cash money. Himself. He bought it, not Amazon. And as Business Insider points out, someone else has made a lot of money off the Washington Post, and that's Warren Buffett. In fact, he has seen 9,000% gain on his Washington Post investment. Matt, is this just yet another genius move on the part of Warren Buffett?
I don't know. I love these big newspaper transactions. It's just, I like Jeff. I respect Jeff Bezos a lot. I mean, how can you not respect Jeff Bezos? But these, to me, are just big ego-driven transactions. It's like, oh, I own the Washington Post. I don't know. In terms of Buffett's return on Washington Post, the company, I think this is, another feather in the cap for long-term investing. He's held that stock basically for forever, pretty much, give or take a year or two, forever. What's interesting, though, is that Buffett continues to be, even though the Washington Post is obviously, it's much bigger than the paper itself, but Buffett continues to be a fan of the newspaper industry, at least from a business perspective. I'm looking at another Wall Street Journal article here that says last year Buffett's Berkshire Hathaway bought 28 papers for a total of $344 million.
Who knew? I didn't know that.
And I think there is still a place for particularly the smaller daily papers where you're basically a monopoly in a smaller area. I think maybe the economics can still make sense there, but I'm not a big fan of the newspaper business.
I think it's worth noting that Buffett I think he earned this $9,000 return, or 9,000% return.
$9,000. That's what
A little bit more than that.
Buffett's going for.
He usually is a pretty silent stakeholder for some of the big stakes that he has. You don't see him making big news about what should Wells Fargo do, even though that's his biggest stock holding there. But with the Washington Post, as Matt said, give or take forever, he was really integral with the operations of the company in the early 70s. He was an advisor to Katharine Graham when she became CEO. And that relationship is actually detailed in the book The Outsiders by William Thorndike, which is a really good book on what makes CEOs great. And it details how she brought in a young Warren Buffett, fairly unknown at the time, to really help with the capital allocation decisions. And he really guided that business, not just from a stockholder perspective, but from an operations perspective, and got it back on track. So he deserves it.
All right. So next up, we got from the Wall Street Journal, Morgan Stanley sees the end of LME warehouse trade. So apparently what's going on here was that because of low interest rates, traders were borrowing money to make metal trades, basically arbitrage in the futures market. But Morgan Stanley says that's all going away.
This is something that's hit the media headlines. It's hit the radars for the regulators. Essentially, low interest rates had inspired investment banks to buy up physical metals stored in warehouses, and then they could sell it on the futures market, basically lock in a risk-free arbitrage profit in there. And this inspired little tidbits like, oh, it's making soda cans more expensive, that sort of thing, which nobody likes. Everybody likes their Coca-Cola. Nobody likes the soda cans to be more expensive. In reality, David has made a good argument toward these banks are smart in terms of finding arbitrage opportunities and taking advantage of them. They weren't doing anything illegal. But if we're to believe Morgan Stanley here, maybe the rising interest rates and some changes in rules and regulations at the LME are going to kind of make this go away quietly. I don't think it should be a big deal for the banks. They'll shift to something else. They'll find the next arbitrage opportunity.
Don't mess with my soda costs, right? Soda's having a good week.
Well, look at Michael Bloomberg. Look at what he said.
Don't mess with soda, with big soda. Don't mess with them. All right. So now we're going to do a deep dive. And when thinking about investing in banking, it's easy to get lost in the big banks and only see them. But you guys recently went on a hunt for value in small banks. So I want to hear about what you found. David, who'd you find?
Well, just on the surface, it doesn't appear that there's as many wow, this bank is so cheap when you look at these smaller banks. I dug into the KBW Regional Banking Index. I'm sure everyone does it. It's not a nerdy thing to do at all. So there's 50 banks, regional banks in there, and these are regional banks that are even below the U.S. Bancorps, the PNC, BB&T. These are really true regional banks, all under $50 billion in assets. And the median price to tangible book, so that's the common multiple that we value banks on, is around 2 times tangible book. When we look at the big four, just Wells Fargo, Bank of America, Citigroup, JP Morgan, not a big sample size, but the average is 1.4. So these smaller banks are getting valued at a higher multiple than these bigger banks. So just on the face of it, they're a little bit more richly valued than the big ones. I think that has to do with they're just easier to understand. I think investors are more comfortable buying a bank that they can really understand the lending operations and understand a little bit better what's on those books. Because if we think back to the financial crisis, the big knock on the big banks was these securities on their books. I don't know what they're holding. The security portfolios are so big. Now the regulation uncertainty. These smaller banks don't necessarily have to deal with that as much. So I think it makes it a little harder to find the value in those really small banks. What do you think?
David said on the face of it. I say on the face of it, nothing. The bottom line is that right now the bigger banks, I think, are just the better value out there. And part of the problem is that the news that we hear out of the banking industry swirls around the bigger banks. I mean, it makes sense, right? So, David and I, we spend a lot of time thinking about, talking about, reading about the bigger banks. So then, we take some time aside and say, well, maybe we're missing something in these smaller banks. Maybe there's some really fantastic deals. But then when you start digging into it, there's really not. You look down. I mean, I look at there's some good banks among these smaller banks. I look at a bank like New York Community Bank Corp. This is a really well-run bank. I think it's got a great focus in the multi-unit type of buildings in New York City. Pays a very steady, high dividend. A lot of investors like it because of that. But when you look at it from a valuation perspective, it's kind of meh. It's like it's okay. You can probably do okay with it. Another one that's an investor favorite, particularly around here, B of I Holding, Bank of the Internet. I think it's a really cool model. They're very much leveraging the internet-based banking, mobile-based banking. That's helped the efficiency ratio. It's a very, very profitable bank. Also very expensive stock. It's trading at above 3 times its book value. So it's earning great returns, but investors have to pay a high price for that, so the returns they actually see. Now, among the smaller banks, and when I talk about the smaller banks, I'm referring to, David was looking at the KBW Regional Index. I'm looking at banks with a market cap of less than $10 billion. One of my favorites, I think, in that group is Huntington Bank Shares. Huntington, great CEO over there. I think it's very well run. They're doing some really interesting things too from a consumer perspective. They have this thing called 24-hour grace, where basically if you have an overdraft, they give you 24 hours to get money into your account to meet what you overdrafted, no fee. So it's cool things like that. They still have true free checking, so they're attracting customers that way, trying to be very customer focused, customer friendly. And when they're competing against like a Bank of America or a Citigroup or something like that, the big banks that have been in the headlines for all of the wrong reasons, I think that can give them an edge in attracting customers, and that's a good thing. Better still, I still think valuation-wise at 1.3 times book value, that Huntington's stock is still a reasonable value. So by and large, I don't think there are a lot of values to be found in the small banks. I'd like to say otherwise,
right.
But we look at the overall market. The overall market has done really well. A lot of the financials have been left behind on the larger end. On the smaller end, I don't think they really have. I think they've risen with the rest of the market and are reasonably, if not in some cases, maybe even richly valued.
All right,
When you look at a bank like Huntington, before the crisis, the story might have been they're an acquisition target or they're going to try to grow to get bigger. Now, after the crisis, obviously banks, they can't make as many acquisitions. They need Fed approval, et cetera. So I think in the long run, I could see a bank like Huntington with that CEO who has stated that they want to grow, they want to get bigger. When the appetite is there for that, I could see Huntington go out and make an acquisition. They are in a region that is, there's some other regional players in that. I mentioned KeyCorp earlier in the show. Them and Huntington, they overlap a fair amount. I'm not calling that they're going to merge in the future, but you could see something like that once the banking environment gets a little more open to mergers and acquisitions. You could see a bank like Huntington do that.
Scale does help. And one final thing that I'll throw in there, people talk about the complexity of the bigger banks, the one-off kind of things. You still have to watch out for that among the smaller banks too. Not necessarily the complexity, but one-off accounting things, that sort of thing. So one of the banks that jumped up on my screen, that jumped out at me as I was looking at these smaller banks, is Synovus Financial. And the reason that it jumped out at me is that the return on equity over the past 12 months in this screen is almost 26%, which looks awesome. If you find a bank that's got a 26% return on equity, that's a pretty good bank. Or, as in the case of Synovus, you got a one-time thing going on. In this case, there was a big tax benefit over the past 12 months. So you just got to be careful that, particularly post-financial crisis, there's a lot of accounting adjustments that are going on because there are a lot of losses that were taken, a lot of tax benefits, that sort of thing. Just make sure that you're double checking.
As well as sales too, not just the tax stuff. A lot of banks sold businesses for liquidity purposes. So if you pull up a stock screen and look at the last 12 months, a bank like Suntrust, they did some sales in the last 12 months, so their return on equity looks a little higher than what the normalized rate will be. So if you're out there looking at these banks, really get in there and try to understand what's been the story the last couple of years. All
right, so unfortunately went hunting and came up a little short, but
maybe
check again in the future.
Empty.
Yeah, all right. Well, now it's time for Rank It. We're going to look this time at the best financial dividend stocks, and we're specifically looking at Wells Fargo, Blackstone, Realty Income, Annaly, and New York Community Bancorp. Who wants to go first?
I will happily go first.
All right.
And let me see if I can remember what my rankings were that I gave her earlier. But basically, oh yeah, there they are. That's helpful. So starting off the top, I am going to talk my own book. I am going to talk my own book. I own Blackstone. This is one of the world's largest private equity advisors. When I think about Goldman Sachs, I also own Goldman Sachs, and now I'm going to double talk my book. Goldman Sachs, I just think it has so much intellectual horsepower, and is so entrenched in terms of people looking at Goldman Sachs, customers looking at Goldman Sachs in terms of these guys are the best. I've got to do business with them. And then potential employees, the best and the brightest out there saying, Goldman Sachs is a great place to work, whether I want to stay there my entire career or I want to take this to whatever other career I want and be able to say, I'm a Goldman Sachs alum, which does wonders for you. Blackstone is sort of like that within the private equity sphere. They actually also have an investment banking arm. They pay a nice dividend. I think the future looks bright there. Next on my list is Realty Income. I mean, as far as a dividend goes, they refer to themselves as the monthly dividend company. They are very focused on the dividend. This is a REIT, as opposed to the REITs that we often talk about here on the show, which are mortgage REITs. This is actually an equity REIT. They own physical properties. These are mostly retail properties. A few of the largest the tenants on these properties include LA Fitness, AMC Theaters, Family Dollar, Diageo, BJ's Wholesale Clubs. So you've got, good solid properties with good tenants on them, paying monthly dividends, paying a strong dividend. I'm happy with that one. Number 3, I got Wells Fargo, which may be a surprise because that is a bit of a lower dividend than the rest. But I'm very confident in Wells Fargo, very confident in their business, in their leadership. Not a great dividend, but I feel like I can depend on it for the next 5 years, 10 years, 20 years, so I can be sure to keep collecting that dividend. So I like that one. New York Community Bank, this is good. It's well run. I have no complaints. Focus on that multi-tenant unit type of unit in New York City. Great place to own buildings, It's just the valuation isn't terribly attractive to me. The dividend's fine. The dividend really doesn't grow. So I'm taking that in the 4th spot. And then Annaly down at the bottom.
Shocker.
For anybody who watches the show, and David who has to listen to me yammer on all the time, I'm just, I'm not big on the mortgage REIT business structure. Like I would prefer this. To me, this is a fund. This is like investing more in a mutual fund or directly in a hedge fund. If I were to invest in a mortgage REIT, probably be Annaly. It might be Annaly. It might be Two Harbors. Those are two of my favorites. If I had to, if you put a gun to my head, David's tried. Didn't work so far, but that's where I am.
All right, David, how about you?
All right, well,
how'd you rank them?
I'm going to start off with Wells Fargo as my first one. You mentioned probably a surprise.
That's a real surprise.
I think the payout or the yield is around 2.7% right now, so not huge. But the banks, of course, are under more regulation, more scrutiny by the Fed about their dividend payouts. So over the long haul, I see them slowly increasing that, just a steady return. And Wells Fargo is the most richly valued of the big banks. I don't think it's insanely overvalued by any.
Well, we just talked about the small banks. When you look at it compared to the small banks, I mean.
And I think when you talk about dividends, you have to look at the yield, but you also have to look at the underlying business, because it's great to have a 5% yield, but if your investment, the capital appreciation, drops by 20%, it kind of doesn't make any sense. I look at Wells Fargo, I see solid returns going forward for this company. I think it's a well-run company, so I'd be confident to collect those dividends, like Matt said, over the long haul. So Wells Fargo, number 1. Number 2, Blackstone, really echoing his thoughts, and these are some bright people over at Blackstone. You just look at what they're doing with the rental housing market. I mean, they're the biggest homeowner in the country now. That's going to be potentially a big cash cow for them. I think you look at them and they're going to find opportunities to make money, and again, over 5% payout. Its future looks bright, like you said. 3rd, New York Community Bancorp. Again, valuation does look a little rich right now. But again, I think you can expect decent returns. I don't see huge downside for this stock necessarily. I don't think it's going to be a huge outperformer just from a stock price perspective. But if you get those dividends and you reinvest them, I think it can be a pretty solid holding over the long haul. Fourth, Annaly Capital. I have it fourth down there despite me being a shareholder.
Is that the only one so far that you actually own?
It is.
Coming in at a strong number 4.
I have it in there as number 4 because we're looking at the dividend right now. I'm a shareholder because I think the book value is a little bit oversold right now. We don't like to use the word oversold. It's a little technical, but I think there's a lot of pessimism built into the book value. The dividend could be cut in the next couple quarters. That's not a huge concern to me. I'm not necessarily invested in Annaly today for the dividend. I see it more as a undervalued book value investment right now. The dividend's kind of a nice sweetener, but sitting as a dividend stock, that's why it's for more of a investment in the book value for me today. And finally, realty income. Like you said, it's a great business. I think the valuation looks a little rich for me. Dividend stocks have had a great run over the last couple of years as investors have flocked there as yields have just been so low. So I'm not sure that the returns from a stock perspective are going to be there for the next couple of years. The dividend's going to be there, the monthly dividend company, that's their slogan. But from a return perspective, I think that could lag the market.
All right.
If you're buying any one of those right now, I'm taking your gun and putting your gun to your own head. Which one are you buying? Besides Annaly, which you got drunk and bought anyway.
I'm gonna help your book. I'll go with Blackstone.
There you go. I like it.
All right, so now it's time to head to the Twitters, like always. First up is from Nick Timaros with the Wall Street Journal. So we have of note in Obama's housing speech. I don't know where I got that from. Of note in Obama's housing speech today, concerned that the pendulum has swung too far the other way on mortgage lending standards. David, when you first read this tweet, what was your response?
There's no winning. No one's ever happy. Before the crisis, lending standards were too easy. Now they're too tight. People aren't getting housing loans from their banks. I was saying before, it's a great political statement. Because if you're out there and you've recently got a loan, you've recently refinanced your house, you're saying, I must be a great customer. They gave me a loan. I'm awesome. But if you haven't and you've been denied a loan, you see this quote or this kind of feeler from the White House, from Washington, and you're like, yay, someone's standing up for me. I should get a loan. So it's a great political statement, or it wasn't a statement from the president, but Timaros is just saying that's kind of a feel on Washington that banks have been a little too tight with their lending standards right now. It's kind of ridiculous. I mean, again, no one's ever pleased. I think the lending standards are fine. I think they're where they should be. We shouldn't be giving loans to people that can't afford it. I mean, that's what got us into the mess. I think they're fine where they are, and the banks will manage the risk appropriately. I hope.
Right. Matt, did you have any thoughts on that, or do you just want to get on?
Yes.
Do you want to get on to the Buffett news? We can get on to the Buffett tweet.
I'd say yes. I think that they did swing a little bit too far in the other direction. I think they're starting to slowly come back to a more normalized place. But I mean, you look at the Fed survey of loan officers, and we're seeing the standards easing substantially on the commercial side. We're not really seeing that so much on the residential side yet, and I think it is just tougher. And part of that is the supply-demand kind of thing, but I think that there could be some more easing, some more loosening to be done. Like David said, I don't like the idea of people getting loans that they can't pay back, and we shouldn't get back into that. But I think the pendulum, that's the way it works, is that things swing too far in one direction, and then they swing too far in the other direction.
Right, and it'll slowly get back to the center, I'm sure. We have to remember that
until it swings way back.
These lending cycles and these standards, they're not like 2-year periods where it just goes back and forth. These can be long, drawn-out cycles. The banks are going to be a little bit shell-shocked for a while because they don't want to make these loans, sell them off to Fannie Mae and Freddie Mac, which is what the majority of loans, that's the process that happens. And if they default or they're bad, then they get sued and they have to buy them back. So it's eventually going to slowly creep its way back, but it's not going to be an overnight thing. So it's taking its natural course of action. It's not going to be legislation that really pushes it back. It's going to be a natural correction.
Yeah. All right, next one comes from Joe Mager, our own Joe Mager. He's at Magyer if you want to follow him. His tweet, Don Graham, in telling WAPO employees about the deal, said that Buffett described Bezos as the ablest CEO in America. High praise. So, Matt, who do you think is the ablest banking CEO out there?
We were talking about this before the show, and it's a tough call. There are a few different guys in the industry that I respect. For this time, I'm going to go with Lloyd Blankfein over at Goldman Sachs. I think Goldman Sachs has had its missteps, no doubt. I think for one thing, any of these really big banks, when you get that many employees, you up the amount of potential bad apples that you have in the mix. But I think Blankfein has done a great job navigating through the crisis. He's done a great job just in general running Goldman Sachs. And it's not an easy company to run, particularly as the business mix over there has shifted so far over to trading exposure, which is, that's a very lumpy business. That's a very unpredictable business. He's done well. And one interesting thing that I noticed the other day is I went on Glassdoor and I was looking at the ratings that banking CEOs got from their employees on Glassdoor. Lloyd Blankfein, if I remember correctly, was at 93%. It's a pretty darn good rating, and is higher than some other CEOs that you might expect would be much higher than that. So Lloyd Blankfein, beloved by employees, beloved for at least right now by me as well.
All right, David, who do you think is the ablest banking CEO?
I'm going to go with Brian Moy. No, I'm just kidding. Not Brian Moynihan. I'm going to go with...
That's just me.
I'm sorry, Brian.
That is just me.
I'm going to go with John Stumpf at Wells Fargo. It's kind of a boring pick. This guy's been there for...
Being able is kind of boring, right?
Yeah, he's been there for 31 years, including he came over from Norwest, so when Wells Fargo and Norwest merged, he's a legacy Norwest guy, and he's managed through the crisis very well, in my opinion. I think they have a great vision for their business. They're very forward-looking. When Bank of America and Citigroup, they left the mortgage business right when you should have been entering the mortgage business in the beginning of 2012. Wells Fargo had all their loan officers ready to make all those refinancings happen, all those purchases happen. I think Stumpf sets the tone there to really be forward-thinking. On the other hand, Moynihan team, they always have to be a little backward-thinking, dealing with all the problems that not necessarily he's created, but just have happened at the company. I think Wells Fargo and Stumpf, they're very forward-looking, and I don't see any reason that shouldn't continue.
Hopefully Moynihan has had his coffee before watching this show, David. You are just...
Too much.
That's horrible.
That's nice of us to assume he's watching. All right, last one. Of course, why not?
Of course.
So next up is just a little fun here. Yet again, Suntrust, Ask Suntrust. Rise and shine. Sam Kinison had a hilarious cameo as a crazy college professor to Rodney Dangerfield's Thornton Mellon in which 80s movie? Now, Matt, you were alive when this movie came out. I assume you were alive, at least alive in the 80s.
Of course, yeah.
So, do you know what the answer is?
I don't, which is embarrassing. I know now because we were talking about it before.
Right.
And David came up with the answer.
And David was alive for how many minutes of the 80s? It was
A
a couple minutes of late. Okay, all right, David, what is the answer?
The answer is Back to School. I have not seen the movie, but I remember seeing it in Blockbuster. If you remember the old Blockbusters, I remember walking past it. And
imagine that, a brick and mortar video store.
Where
Weird
you
concept.
stand there and you just stare at the wall and you'd be like, oh.
But this is the second Suntrust tweet that we looked at. The first one was about J.K. Rowling. I mean, the tweets are really random, and I mean, I guess whoever's manning the Twitter seems like a jolly fellow over there at Suntrust. I don't know. I like the idea. I like the idea. I don't know.
I think it's a neat marketing technique because I've now seen these on a couple occasions. There's this one, like you said, the J.K. Rowling. There's another J.K. Rowling one that I saw. So, it kind of gives you this perception of Suntrust as kind of a nice, friendly, bank next door, as you might say. You don't think about banks like that. So I think this is a neat idea for them to do. And they keep it PC enough that you're not going to offend anybody with this kind of thing. Although, I will say, I'm going to go out on a limb here, I never really found Rodney Dangerfield very funny.
I'm just gonna say,
yeah, of course
right?
that's
Anytime
gonna,
someone
of course
says
that's gonna come
Caddyshack,
up.
you gotta.
You can't say, oh, I didn't really like Caddyshack. Of course I liked Caddyshack, but not Rodney Dangerfield. Just not a big fan.
That's fine. So if you're listening at Ask Suntrust social media team, if you're ever in Alexandria, come on by and we'll take you out for a beer because you sound like a great fellow or lady to hang out with.
Yes,
yeah? Agreed?
absolutely.
All right, or we'll rent Back to School or something. I don't know. All right, I think that's it for today. Yeah, all right, we're all done for today, so we will see you here tomorrow. On behalf of Matt Copenheffer and David Hansen, I'm Allison Southwick. Fool on.